Good morning and welcome to T-Hub Capital, the Investors Lounge, the podcast where we explore financial market dynamics, emerging trends, and the insights that shape successful investments. Each week, we'll delve into the strategies and analyses that drive our investment decisions. You'll get an insider's perspective on the factors influencing markets and the potential winners and losers of tomorrow. Subscribe to the podcast to stay ahead of the curve and make informed investment choices. Enjoy listening.
European markets rally as monetary policy outlook shifts. The Pan-European Stocks Europe 600 index reached a new peak last week and closed with a gain of 1.00% in local currency terms. This upward movement was primarily driven by growing confidence in the resilience of the Eurozone economy, which provided enough momentum to counteract recent periods of market instability. Performance across the continent was broadly positive, with Germany's DAX climbing 0.74%, Italy's FTSE MIB increasing by 0.77%, and France's CAC 40 outperforming with a 1.81% advance. In the United Kingdom, the FTSE 100 index also saw significant gains, rising 1.43%. In terms of monetary policy, the European Central Bank maintained its key deposit rate at 2.0% for the fifth consecutive meeting. The Governing Council noted that the regional economy remains robust despite global headwinds and expressed confidence that inflation is on track to stabilize at the 2% medium-term target. President Christine Lagarde characterized the current economic environment as broadly balanced, suggesting that the prevailing policy stance is appropriate for the time being. This decision followed data showing a sharper than anticipated slowdown in January inflation, which fell to 1.7% year-over-year. The cooling of price pressures was aided by a strengthening euro and lower energy costs, while core inflation reached its lowest point since late 2021. Regarding consumer activity, Eurozone retail sales figures for December showed a sequential decline of 0.5%, a result slightly below consensus estimates. Furthermore, previous growth data for November was revised downward to 0.1%. Despite this monthly dip, the overall volume of retail sales for the final quarter of 2025 rose by 1.4% compared to the third quarter, indicating a general recovery in household consumption toward the end of the year. Meanwhile, the Bank of England opted to hold its policy rate at 3.75% following a previous reduction in December. The decision revealed a notable internal division, as 4 members of the Monetary Policy Committee unexpectedly supported an immediate rate cut. This development led market participants to increase expectations for a potential easing in March. Governor Andrew Bailey confirmed that further policy relaxation remains a possibility, particularly as the central bank now anticipates inflation hitting the 2% target by April, significantly ahead of earlier projections. Bailey also noted that the market's expectation of 2 rate cuts within the year appears to be a reasonable assumption. Now our insight into alternative markets. The liquidity revolution. How secondaries became the new epicenter of private capital. The landscape of global finance is witnessing a structural shift that would have been unimaginable to the early pioneers of the 1970s. For decades, the private equity life cycle followed a linear path: raise capital, invest, and exit via a trade sale or an initial public offering, IPO. However, as Moelis & Company Managing Director Paul Sanabria recently observed, a new reality has set in. For the past 3 years, the secondary market has consistently eclipsed the IPO market in terms of transaction volume. What was once a niche, opportunistic escape hatch for limited partners, LPs, seeking early liquidity has matured into a sophisticated, multi-strategy global capital market with annual volumes now exceeding $220 billion. The journey from the market's origins to its current 2.0 status is a masterclass in financial evolution. In the 1970s and 80s, firms like VCFA, Landmark, and Collar operated in a landscape defined by necessity, providing liquidity to LPs when few other options existed. By the 2010s, the market began to pivot toward GP-led restructurings, a trend that has since exploded into a dominant force. Today, general partners, GPs, are no longer using secondaries just for troubled assets. Instead, they are utilizing continuation vehicles to hold onto their high-conviction trophy assets, companies with exceptional growth profiles that the sponsor is not yet ready to exit. As traditional exit windows like the IPO market remain constrained throughout 2024 and early 2025, these GP-led transactions have transitioned from experimental tools to standard exit paths, now accounting for nearly 14% of all sponsor-backed exits. This maturation is attracting a surge of new capital and institutional heavyweights. Traditional asset managers like Blackstone have long recognized the scale of the opportunity, but the most recent wave of expansion involves direct private equity sponsors launching internal secondary strategies. Firms such as New Mountain Capital and Warburg Pincus are now entering the fray, seeking to capitalize on their sector-specific expertise to underwrite complex deals. By January 2025, New Mountain had formalized its own continuation fund strategy, while Warburg Pincus expanded its reach through strategic partnerships in specialized areas like real estate secondaries. This influx of smart money is not only providing depth to the market, but also increasing the transparency and competitive pricing of assets that were once considered illiquid. Looking ahead to the next decade, the secondary market is poised to become the primary engine of liquidity for the entire private equity ecosystem. The definition of a trophy asset is evolving to include scaled, cash-generative leaders in resilient sectors like digital infrastructure and healthcare, which are perfectly suited for extended holding periods. As dedicated secondary dry powder reached an all-time high of over $300 billion in mid-2025, the market is no longer just a countercyclical solution for times of distress. It is a permanent, high-growth pillar of the financial world, offering a flexible third wave for sponsors to maximize value while delivering much-needed distributions to their investors.
Thank you for listening to this episode of T-Hub Capital, the Investors Lounge podcast. I hope you found this content interesting and inspiring. If you enjoyed this episode, don't forget to subscribe to the podcast so you don't miss a single episode and share it with your friends and colleagues who might be interested. To learn more about T-Hub Capital and our activities, visit our website, hubcapital.com. You can also follow us on our LinkedIn page. See you soon. All the best from the T-Hub Capital team.